Why everyone bought thematic funds at the peak, the herding instinct. Good morning, investors. I want to start today with a man who predicted two of the biggest market crashes in modern history before they happened. Robert Shiller, Nobel Prize winner in economics 2013, professor at Yale University, author of a book called Irrational Exuberance, published in March 2000, at the exact peak of the dot-com bubble. The book warned that markets were dangerously overvalued. Within months, the Nasdaq crashed by nearly 80%. Shiller did it again in 2005, warning about the US housing bubble. 3 years later, it burst and triggered a global financial crisis. What gave Shiller this ability to see what others could not? He understood one thing about investors that most economists refuse to accept. He argued that investor psychology is so given to herd behavior, to following the crowd, that markets can go through significant mispricing lasting years or even decades. In other words, when a crowd decides something is worth buying, they can keep buying it long after the price has stopped making sense. And when that crowd eventually turns, the correction can be sudden, sharp, and painful. Now, why am I telling you this today? Because what happened in India's thematic and sectoral mutual fund space between 2023 and 2025 is a textbook, real-time illustration of exactly what Shiller spent his life studying. The herd in action. Cast your mind back to 2023 and 2024. Theme after theme were capturing investor imagination. Manufacturing, infrastructure, defense, PSU, energy, green transition. Each one came with a compelling narrative. India's growth story, government capex, the China Plus One opportunity, the defense modernization push, and the returns? Spectacular, multi-year returns that made everything else look ordinary. Money followed, as it always follows a good story in a rush. Since July 2023, thematic funds alone pulled in nearly 2 lakh crore rupees from Indian investors. In December 2024, just 1 month, these funds attracted over 15,000 crore rupees, more than any other category, more than large cap, more than flexi cap, more than debt. Everyone was buying, the crowd was moving, and following the crowd felt not just logical, it felt safe. It felt like the obvious thing to do. This is the herding instinct at work, and Shiller would have recognized it immediately. What happened next? By early 2025, the picture changed. Inflows into thematic and sectoral funds dropped sharply as volatility returned. The PSU and manufacturing funds that had delivered spectacular multi-year returns were down sharply. Investors who had entered at peak valuations, following the crowd, chasing the narrative, doing what felt obviously right, found themselves sitting on significant losses. Nothing fraudulent happened. No regulatory failure. No black swan event. The market cycle simply turned. As it has always turned, as it will always turn. The only thing that went wrong was the decision-making process that brought so many investors in at exactly the wrong moment. Why we herd? I want to be clear about something. Herding is not stupidity. It is not greed. It is a deeply human instinct. When everyone around you is buying manufacturing funds and celebrating returns, when your colleague mentions it at lunch, when your WhatsApp group is full of screenshots of gains, when financial influencers are calling it the next big theme, not buying feels like the irrational choice. Social proof is one of the most powerful forces in human psychology. The brain interprets popularity as safety. If everyone is doing it, it must be right. But Schiller's entire life's work shows us the opposite is true. By the time a theme is popular enough, celebrated enough, discussed enough to attract 15,000 crore rupees in a single month, the investors who benefited most are already inside. They went in when the idea was uncomfortable, when the narrative was unproven, when the crowd had not yet arrived. By the time the crowd arrives, the easy returns are usually already behind it. One question that could protect you. Before any investment decision, ask yourself honestly just one question. Am I buying this because I have genuinely analyzed it? Because I understand what it holds? How it has performed across different market cycles? What risk it carries? Or am I buying it because everyone else seems to be buying it? Because it feels like I might miss out if I don't. If the honest answer is the second, pause. Do not exit immediately. Do not panic. Just pause. Think. Look at the fund's last 3-year performance across both bull and bear phases. Ask your distributor to explain the concentration risk in a thematic fund. That pause, that one moment of independent thinking in the middle of a crowd could save you years of waiting to recover. The real lesson. Robert Shiller did not predict 2 market crashes because he had a crystal ball. He predicted them because he understood one uncomfortable truth, that crowds can be wrong for a very long time and then suddenly and painfully right. The herd is not your enemy, but it is not your guide either. The herd moves towards the same exit at the same time, and the door is never wide enough for everyone. My WealthWise pin-up rule for today. When the crowd rushes in, slow down. When the crowd rushes out, slow down. Wealth is built in the pauses that the herd never takes. Tell me honestly in the comments, did you invest in thematic or sectoral funds between 2023 and 2025? Which theme attracted you? And did you get in before the crowd or after? No judgment here. This series is about recognizing these patterns, not criticizing them. Drop your experience below. I am MV Suresh, founder MV Suresh WealthWise. For regular mutual fund updates, connect with me on Facebook, Instagram, LinkedIn, YouTube and Telegram. Wishing you good financial health. I'll be back tomorrow with a new tip. Till then, stay wealthwise.